and 10.
It's in. Let me just dial myself in a little bit there. There we go.
Oh, that was interesting.
A little bit too close for comfort. How are you, mate?
I'm good, my friend. I'm good. How about you?
Mate, doing fabulous. Massive week. I was up your neck of the woods on, everyone knows that I was up your neck of the woods.
Last week we hung out, which was awesome and fun. This week we're back to the digital engagement space and place. But there you go. Got a few of the crew in the house. Melinda, happy Friday to you. Hello.
Happy Friday.
Oh my God, here we go. Oh, we got a few people into.
Oh my God, here we go. Well, there's somebody who's been here before.
Welcome, whoever you are, wherever you're dialing in from. Looks like you're probably from one of the private Facebook groups. There you go. Oh, Deb, you're online. Hope you're all right, Deb. Are you sitting in the Debbie, you're sitting in the airport or something, or maybe on the train. Hopefully you're good, Deb. I caught up with Deb today. Nice hanging out with you, mate. And Jeff is there. I know. What did you do? What did you do, Jeff? You got banned. Anyway, we'll find out, mate. Hello, Trace. Oh, where are we? Here's Tracy. There we go.
Hey, Trace. Well, welcome everyone.
On the miso soup. Someone's on the miso.
Miso soup.
Well, there you go. That's healthier than the wine. But let us know what your liquid of choice is this evening, ladies and gents. It looks like Alison might be on a glass of wine.
I actually read that as W2TF, not FTW. I'm wondering whether somebody's got the.
Well, the dyslexia is kicking in, mate. It could be. It could be. Well, there you go.
Alive and well.
Yep. And we've got Murray Fitzpatrick in the house. Big shout out to you, Andy. Yeah,
mate,
long time no see.
A blast from the past. A fellow hockey player. I'm not quite sure if he made the Australian and Victorian teams. Very a hockey family and a stellar bloke in the financial services chapters. Hilarious as well. Business coaching as well. Good to see you, Murray. Great to have you on board.
Absolutely. Well, folks. Awesome to have all of you guys joining us today. And, mate, good to hang out with you as always. We've got a few things, lined up for later on in the show. Most of you know this, but Andy and I always do the little intro for anyone who's new. Let us know if you're new, dropping by in the chat. Let us know if you're new. There you go. Murray said he played for Oz. I played in Oz, not for Oz. So there you go.
We don't always say it in that kind of order. Sounds better one way. Yeah.
There you go. Oh, here we go. It's for the win. There you go. Young person
for the
speak.
Win.
Yeah. We learned something, Clinton. We learned something.
There you go. For the win.
Awesome. Well, folks, as a few of you already know, Andy, and you guys, some of you guys have been doing this for a while now. I think we're in our third year, and
wow.
Kicked it off, debriefing the week, lots of things going on. And as there is often plenty of things going on in the world of real estate, my neck of the woods, Andy's neck of the woods, the world of finance and the share market, financial planning and business. We combine our general knowledge, our experience of these couple of interesting places to hang out and create careers and help people make sense. And Fridays over a glass of wine many years ago when COVID kicked in, we decided we would debrief our own week each. And then we decided we would include debriefing with our customers. And this is where Wealth, Wine and Wisdom came from. And we've been doing it fairly consistently for a while now. Well over 100 shows. And Mostly, we don't drink too much wine, and we usually spread a little bit of wisdom, and hopefully tonight will be that, folks. As you can see down the bottom, Andy, we do a few things. Have a little chat about what's in the news.
Get the questions out nice and early before Jason drinks too much out of that plastic glass. You've got the plastic back there.
I've got the plastic back here, mate.
I tell you what. It's unbelievable, ladies and gentlemen. I've tried. Yeah, I can see it. It's now good wine out of a bad glass. It's a terrible statement. Yes. Headlines we've got looking in on your side of the neck of the woods this week. What do we got to? Because I know we've got some interesting things from BHP, some radical headlines. We've got some good things to share. We've got some questions from last week. But mate, what's been raising your curiosity over your side?
What's going on? Well, a little bit of talk about inflation, Andy. It's something that has been sort of popping up, and it's a bit of a clickbait of recent times. Inflation 8%, etc. Blah blah blah. One thing this week. Looking around that, I think we'll touch on that a little bit later on, folks. But core inflation, headline inflation, and there is a difference. And what does that mean? We might circle around on that. I did dangle this carrot, Andy, earlier today with some folks to say, hey, come and hang out with Andy and I. We might talk about inflation if that floats your boat.
Wow.
Yep.
Friday nights are dead.
Yeah, I didn't get too many takers, but we shall see who rocks up. But mate, there's some things I wouldn't mind asking you. There was an article I was reading about are bonds back in favour, Andy, for some defensive assets. That'd be an interesting conversation. Certainly, folks, there's a lot of talk about interest rates going up. I've been doing this one for a while, but Andy, there's actually a lot of talk about wages going up too for a lot of people. So I've got a few things that are there, and just the regular old media circus about the boom is over and property prices are going to plunge 20 to 30%, which I think is rubbish. But that's what's going on in my neck of the woods, headlines. So if you've got any questions, folks, put them in the chat for us now so we can line them up for the conversation, the show. But mate, what about in your neck of the woods? You and I were chatting a little bit before.
Well, mate, it's been a good week this week. We've got some record dividends, a new record, Jace. Some record dividends
records being broken everywhere.
And where did we finish up? We finished up at 7,000 on the All Ords, so not quite the crash and the doom and the gloom that our conspiracy.
I thought it was over, Andy. I thought it was over.
It was over. We were building bunkers. That's what we were doing. But we expect more volatility in that. But the markets have responded reasonably well, and as tends to be the way, money has found its equilibrium, flowed back into the markets, brought back to realistic values. There's been some interesting headlines over in the US, and for those people who love Tesla, love some of the international stocks, your Googles, your Amazons, all of these sorts of things. Now the headlines are starting to go, yeah, are we near the bottom? Which people love that kind of media, but generally it's no, we're not. We're either back on the way up, and we have been for a little while, or the bottom's still to come. But there is some validity in some of these comments. So now the sentiment, the opinion pieces are now starting to turn over in the US, and they've copped a fair whack. But there's also so here's a little bit of future gazing. Next RBA bank rate raise, I reckon, will be potentially one of the biggest for no other particular reason. And please don't quote me on it in any way, shape, or form, because it's a ridiculous hypothesis as to the reason why I've come to this belief. But let's see how we rock and roll with it. So Powell's come out and looking at a 0.75% increase raise. So 0.75.
That's the Fed. That's the Fed out of the US. Yep.
The US Federal Reserve, a 0.75% headline rate. What did our old mate? What was his name? We picked on him a little bit.
Christopher Joyce.
Not too long ago. Christopher Joyce.
You've been dialing out that for weeks, mate.
let me bring him back up, because we made a dishonourable mention back by our old mate here. And so again, RBA duped Australia, Aussie households. This was the interesting part that Jason and I loved. With where was it? Most aggressive rate increases in the world, right? Most aggressive. And Jason and I went on to say, well, This little increase down here is Australia. This one here is New Zealand. You don't have to go too far to figure out that he's probably wrong.
Yes.
So, mate, just another one over the horizon with this is that it's looking like the Fed will be even more aggressive, looking to be a little bit more like a couple of the rate rises that New Zealand did. And
yeah,
I think top and tailing into some of the things that you've been talking about, if we want to chat inflation, what's headline, what's core, how does the RBA measure it? Is it real? Is it transitory? Should you be worried about it? How should you be worried about it from a stock market level? Should you sell and go and buy that bunker? You can probably get a concreter to deck out the bunker based on some of Jason's statistics, which we might go into soon. Those of you who have watched, why do you think it's not a bad time to build a bunker right now? And I'll give you an idea. It's got to do with concrete. And if you can link those two together, well, you're a very talented human being. But there's a strong
connecting dots. Yeah.
There's a strong correlation. But so the Reserve Bank, the Fed Reserve, potentially going for a 0.75% interest rate rise. I think it actually gives a bit of leeway. Like if we have a look at economic policy, both politically and from the RBA over a fairly significant period of time now, even if we go back to the big reductions in rates back in the GFC, and I think I've got a little slide that I can pull through on this one. It might take a few seconds to update. Yeah. And you might have it, Jace, was the cash rate here in Oz. So one, allegedly, Jason, we're a bit of a copycat out here. And so we tend to mirror what the US does almost directly, and so as rates were cutting over in the US, aggressively cutting for different reasons, we aggressively cut it as well, or cut our rates as well. So it wouldn't be too long a bow to draw, Jace, to kind of go, well, if they were if they were going to do a big rate rise, would they do it on the back of the US doing a 0.75? Total conspiracy theory. They're two random dots that I've just collected and I'm throwing out there. But I reckon that there's a reasonable chance that that'll come back in. And should they do that, then it'll be shockwaves and horror back through, economic markets. It'll hit the share market. We'll get those headlines back again. So I think we're in for some turbulence. So maybe we have a bit of a crack at how we can moderate that turbulence, stay sane and stay balanced while we're about to go through, I reckon, some interesting headlines and potentially some interesting maneuvering, both politically and from the reserve banks and central banks of the world.
Yeah, I reckon, mate. Yeah, for sure. Like for me, in the real estate world, people sit on their hands when there's uncertainty. So, not a lot goes on. And certainly I think for me, if I was to say, what would I prefer? I'd prefer 2 times 0.75, quick as they can do it. Just get it over and done with. That's be my preference. I was chatting with the team earlier today about that, and just say, hey, listen, get it done well before Christmas. Then people realize the world hasn't ended, and it'll shake out a little. Give it 6 to 9 months, and then my world, the real estate world, will say, hey, listen, let's kick on a little bit. And I've got a few slides to share a little bit later about that. When it comes to the shocks in real estate and how quick it goes from, peak to trough, Andy. And, you've talked about this before in the share market as well. What was the previous high and how far above the previous high we were. But I'd be really interested. I know you've got a couple of things there. Let's talk about inflation, and we'll tie this back to some of the other stuff that we're looking at. Maybe have a little nosy at that. But good to see a few of you here. I think a bit of a shout out to Chris and Luke. Thanks for joining as always. Joe Marley popping by from your neck of the woods, Andy, one of your team, one of your crew. So good to see. Good to see in the house, Joe.
You on, Joe? Yep. Yeah. Joe's. It's wealth, wine, and wisdom every night of the week for Joe these days. He's got a free house. So, mate, just going back to what we were talking about as far as the cash rate before, I literally just found this from Business Insider just while we were chatting, so I haven't got the most up to date. I'm sure we've got it in previous slides. One of the things that people get quite scared about when the cash rate moves, because they go, well, Jace, allegedly these are smart people. We don't want to get sued, so we'll say allegedly these are smart people are making decisions, and based on policy, like we went through last week, there is a mandate that the RBA have to follow, and it's the broadest mandate, or one of the broadest mandates in central banks in the world.
Yep.
The current government want to make that mandate different to disguise, to blame the
Their
Fed.
inefficiencies.
Look at this hand while we do something else over here. So there's all that stuff going on. But look, if we had to draw this graph out now, it's sort of, where are we to? It's sort of around here somewhere, right? Or it was flat for a while, and then we're kind of up like this. So what we've got to realize is that if we drew a trend line between here, where potentially if they were able to raise rates in a more linear way and control the economy, they overreacted, so they had to react back.
Yep.
Then stabilize for a little while. Then they had to react reasonably quickly because inflation was kind of going a little bit out of control. All of a sudden, before the world just dropped off the edge of the cliff. But they overdid it, overshot the mark by quite a few percent. So that's 2% to about 4.5%.
Wow.
Right? So that's double the current rates that we're on, right? Roughly is how much they increased it in a very, very short period of time.
Yep.
So I guess the reason why I'm kind of illustrating this as one of the headline slides for the night is just because rates go up quickly doesn't mean they're going to stay up for a long period of time.
Yeah, correct. Yep.
As a matter of fact, the faster information flows around the world, the faster and the quicker things tend to mean revert.
Well, what I mean, Andy, arguably, if you look at each of these, very limited ups and downs here, they seem to have gone down as fast, if not faster, than they went up in over adjustments and stuff like that. So, I have been privy to a few conversations in this space. It's like, yep, they'll probably go a bit hard and then have to back it off a little.
And the thing that we need to be careful of as investors in the market and investors in shares and investors in real estate is we can't, switch off our strategies when we get to these points, because when you listen to these, what's a nice word? Idiots. We just use idiots who just start peppering fear mongering out in the market. Then you'll think, oh my God, I've really got to get out, and you start to look at selling down the loss position, and it's quite possible that we're going to see some significant rate rises, and it's going to be scary for the market because people think that it's going to remain for a long period of time, and the reality is that it's probably not. And there's some reasons that we're going to go into later based on transitory inflation, which means inflation that is costs of goods are high now, but they'll actually come back down reasonably quickly.
Yeah.
And we just, as investors, we just need to understand that just because it's today's headline doesn't mean that it's a lifelong burden that we're going to have to carry. Because unfortunately, some people go, oh my God, 4% interest rates, we're going to be there for the next 30 years. Oh my God, my interest rate payment's gone up for the next 30 years. Not necessarily. And
arguably, Andy, even if it is 4% for the next 30 years, that's something to celebrate, folks, because the 30 years beforehand,
that's right.
The average was friggin' 4% more than that, So, perspective is something that's interesting. And what I think what happens with this stuff, Andy, often is some investors get a little bit one-dimensional. And this is, you and I talk about this, it's not a one-dimensional conversation. Interest rates go up, so too do other things at some other point. And depending on what exposure you have, right? So let's have a look right now. Tell me, folks, in the chat, what else has been predicted to go up 20%? Well, not necessarily predicted. I'm not going to say predicted. But what is being argued about and asked for a 20% increase? I've got a couple of articles showing this right now.
Mate, this wasn't pre-planned, but if it's what I'm thinking about, the last time it happened and Gough Whitlam brought it in, we went into the deepest, darkest recession Australia's ever seen.
I don't think it is this, but Andy. So, folks, everyone's saying, "Oh, well, my interest rate might go up 20%," but what else is going on out in the marketplace? And I'm not talking about rents right now because rents are on the rise, folks. But what else is happening out there in the world of our, exchange of goods and services when it comes to businesses and jobs and stuff?
Viagra sales.
Probably.
I think Jeff, only people who take them would actually know that, mate.
But if we have a look at this team, let's have a little cheeky one, cheeky sticky beak here. Well, let's I'm going to go up there. There we go. Look at this right now. These are just some, and I should have collected a few more, ladies and gents. But lawyers have enjoyed their biggest pay rise in decades. So not only, let's say, interest rates are looking, maybe they will go up and pass on to consumers, ladies and gents, but some things are being passed on as well. We've got, lawyers getting a 20% pay rise. The train union looking for another 20% pay rise. And I know there's other industries that are asking for, pay rises to cover costs of goods and cost of living and those sorts of things, Andy. But for all of us, what we must rationalize as investors is to say, all right, well, it's not a one-dimensional conversation. The only thing that's going up is the cost of my interest. Well, no, that's not true. Right? That's not true because there's other things. It's kind of like I don't know. I'm trying to be very scientific here, a bit more, there's nothing neither created nor destroyed. Scientific, when something transforms from one place to another, there's an equal and opposite reaction to it. There has to be.
Newton's law of relativity.
Newton's law of relativity. That's the one. I went around for that one, Andy.
That's only because you're on the train tracks, my friend. It's all good. You're on theme.
On the train tracks. There you go. Well, yeah. Well,
so when you see things like this, you say interesting. I think interesting. And you say opportunistic. I think
absolutely. So
absolutely. When is the best time to try and raise average wages? Right now.
Yeah.
Now this same thing happened back, I can't remember because I was too young. Some of you old buggers might remember this.
Back in my day.
Maybe you, Jace, maybe you. It was when I was very, very young, but Gough Whitlam went out and raised public servants' wages. I think it was somewhere between 10 and 20% overnight, literally overnight, and it broke. It didn't just slow; it broke the Australian economy.
Wow!
Actually,
Andy Fenton. Interestingly, you say that. Here we go. Check it out. Well, this is public servant bonuses spark envy in other governments, right? So this is kind of like if we think about it right now, folks, and this is not a conversation about saying anything untowards against people who are looking for a pay rise or whatever it is in their world, and if they're worth a pay rise going for it. This is not the conversation we're having. We don't discourage anyone for asking for more, if they're worth it, etc.
It's a fair conversation, and there's definitely areas. There's definitely areas where people are underpaid and should be paid more.
Yep.
But we can't. What my stance is very firmly is. It doesn't mean it's not. Oh, well, if my next door neighbor got it, everybody deserves it. That's not, and it's not good for the person who gets it because it's not good for everybody in the economy. Because if these things happen en masse, then all of a sudden, exactly,
Bryce, with hyperinflation. Yeah. Yeah.
And spiraling deflation as a result of it, because all of a sudden, Jace, if you had to pay everybody in your business 30% more, you'd have to lay a lot of people off.
I'd be shutting the doors. And this is it. And this is a conversation, Andy. Like, there was a little bit of conversation the other day about the new. I'm having a mental blank. Anyway, he does the accounts for the country now because Labor's in. What's his name?
Still getting used to the new names, isn't it? I can think of Powell before I think of him.
Yeah. Well, anyway, the new
treasurer.
Yeah, the new treasurer. He's saying, well, listen, folks, if wages go up madly,
Jimmy Boy, we'll call him Jimmy Boy. We'll give him Little Jimmy. We'll call him Little Jimmy. That'll help us.
If wages go up madly, then businesses will have to. Jim Chalmers, there we go. Good work, Luke. I'm glad you're there, mate.
Luke's our statistician for tonight. He's already pumping stats through. Thank you, Luke.
Mate. Yeah. But if that happens, then that will lead to people losing jobs. So our record employment will actually now be 4% instead of 3.5%. So it's an interesting one, Andy. It's a funky time right now when it comes to this stuff, and we need to navigate it well as a economic opportunity to not squander where we're at right now.
And we've said it many times before, and I'm just seeing, because we've used this graph many times throughout the last 12 months. You can't find it when you're looking for it. It's like the salt, Jason. It's like, where's the salt, honey?
Damn salt.
It's right there in front of you. It's not. It's definitely not. It's definitely not. It's absolutely not. Wherever you bloody put it, you've moved it, and then she comes up and goes right there.
Right there. Well, I mean, while you're looking for your thing, whatever you're looking for, your graph, my point, folks, is that, if you're worried about a headline of, your interest rate going up, certainly as investors, we've actually able to, let's say you are able to get, a little bit of a pay rise bump, $5,000, let's say your rent goes up $50 a week. Okay. And right now, folks, if you're buying a property, the cost of construction has gone up. That then leads to the cost of the building you can depreciate, which you actually get more tax deductions back. You actually get more tax back. So we were doing this, recently this week, Andy, and $5,000 there, $50 there, more depreciation back, more than offsets the interest rate rises for property investors. The ones that will struggle will be, the PAYG mums and dads who don't have any ability to kind of hedge an expense increase, which is their major increase in their life, right? Other than children, is their mortgage. Yeah, there you go.
Do we put them on the eroders of wealth scale now? It's
I
children.
think so. Yeah. Well, wealth erosion. How did you go with your thing, mate?
I think I got it, and I had to Google around because I don't think we've actually chatted about it in the last 12 months, which is interesting. So when we look back at good old Goff and his period of time, did a lot of good things, did a lot of interesting things, did a lot of not so good things, and if we just overlay this is the 10-year government bond chart here in Australia, right? And so the effects and what we want to be careful of, and we certainly want to moderate, and this is the Reserve Bank, this is the government introducing good policy. Can't say it with a straight face. Yeah. So it was around here, and those that are older than me will know better. Goff made this move, right? And so in a single move, raised the public servants. So it's a massive community. Wages right across the board. And what ended up happening was we ended up with mass inflation, which Luke talked about. Now, this actually sparked what's been going on ever since. Right? Since I've been born, pretty much. I was born as interest rates were going up, but they've pretty much been coming down ever since I was 1 or 2 years of age, because this is what interest rates have been doing. Now we're just going in the upwards direction again. So what we need to be careful of, so the biggest potential to destroy massive amounts of wealth is because if you go, okay, all of a sudden, lots of money was injected into society, right? And it was injected into society by wages. So your average person had significantly above average more than what they usually had in their pocket. So what did they do? They went out and went on a spending
Consumption,
spree.
mate. Spend it.
And so what happens to the costs of goods? Now, this is a healthy type of inflation, right? This is when people's
money
demand,
flow inflation. Money flow.
Yeah.
Yep.
Right. Oh, that's a new term. Actually, I reckon that's a great term for it. Money flow inflation. More money circulating around in a healthy way in people's pockets. Well, there was too much, right? And if we go, well, let me ask you the question. Put it in the chat. What's happened more recently, which is a similar type of effect to what Goff did back in the day of raising wages right across the board? What is something common? Whack it in the chat that happened just recently that had a similar type of effect on our economy.
Oh, I can tell.
Mr. Whitten in the front row. Yep.
Well, lots of COVID cash and grants and stimulation of recent times. One of the big stimulations, COVID cash, mate.
Mate, you are spitting out the headlines right now, aren't you? COVID cash.
COVID cash, the COVID stim, the job keeper. That's exactly right. Stimulation, yep. Free money.
Yep, everyone's got it. Whack them up there, Jace. What is it? Tucky's in there. He's
we got the job keeper. We got the COVID stimulation. We got the stimulation here. Free money. Yeah, I mean, the free money. Like I helped so many people, get between $50,000 and $70,000 worth of free cash from the government to buy houses, especially first home buyers. It was ludicrous. People were getting free houses, Andy. Like it was. It was mad. I mean, you remember us talking about it. I'm going, I can't believe this is going on, Andy. Like, this is just insane.
Well, this is how we started, wasn't it? This is how Wine and Wisdom started. How do you get your money on the COVID cash?
I'm like, Fenton, this doesn't make any sense, mate. Like, help me work it out.
It doesn't need to make sense because it was designed by the government. It should be in the disclaimer at the bottom. It doesn't need to make sense. Brought to you by the Australian government. So the big danger here is, and we have got politicians that are driven by popularity, right? Politicians driven by popularity. It's a social media contest, and that's not what it should be. It's just this is a big business. This is as big a business as you can possibly get, but it's a popularity contest. And what we need to understand here is that we've had a massive. So imagine, Jason, if you will, imagine that this was 2020. Let's just change the timeline a little bit, right? And let's just go, well, before wages, this is the CC. You can't say no, can you? COVID cash.
COVID cash, mate. COVID cash. Take it, folks. Well, not only COVID cash, Andy, we were coaching our clients because we didn't know what's going to happen to, squirrel away all cash. So, if they didn't have to make a mortgage payment because the bank was going to let them have a pause for a bit, we'll squirrel it away. It was COVID cash. Yep.
We were squirreling away the COVID cash and we were investing everything else. I think we were throwing the wallets at everything at the beginning. Yes. Everyone thought we were mad. I thought we were crazy, but geez, it was a good move. But so imagine that this first step, and I'm not suggesting that this is what's going to happen, right? But imagine this first step is COVID cash. So imagine this is the inflationary cycle that's then now lifting rates like it is here. And I'm scribbling everywhere. I should change the color. Whoops. Oh, no.
Fenton's gone. There he is.
Oh, mate, it's all happening here. Technology issues. So let's just say that this first part here in the green, let's just say that that's COVID cash, right? If we en masse raise wages too aggressively, then we could be in Goff 2.0. Now that's sort of the big danger. So now, and I say too aggressively because I think in some areas it's warranted, but we need to contextualize the arguments. People are saying inflation is running rampant. We need more forever. And that's what is being stated. Inflation is the assumption is inflation is going to be here forever. So we need more money forever. Let's just simplify it.
Well,
the reality
level of inflation, right? 8% is going to be here forever. Nah, well, hang on. Let's check in on that. Yeah. So, you said you were going to do this. What the hell is a stochastic walk?
So, ladies and gentlemen, put it in the chat. There's notoriety, fame, and fortune, and all those wonderful things that you can get. If you can tell me in layman's terms, not in Google's terms, what a stochastic walk is.
I was going to say, Vincent, I'd be just Googling right now going, what the...
But you got to simplify it because we're only going to be able to see 2 or 3 words, and we've got to figure it out. Tell me, please.
I don't even know what it is. So there you go. What the hell is that?
So, let me give you it's not this, right? It is not this. Right, it is absolutely 100% not a lane, trotting down the street, just looking a little bit unusual. But it's also known as a random walk, and it's a financial theory starting from the stock market prices evolving, basically saying that there's no correlation; it can't be predicted. Right, that this thing changes, and it changes so rapidly that we can't really assess it. They're just random. It's totally random.
Yeah.
Now, we know that that's not the case. It's not totally random. There are trends and things that come along with it. So what we do realize is that in data sets, and this is very true of inflation, like this is statistics 101, but this goes to how we judge inflation, how we calculate inflation, how long inflation will last at current levels. And, have we got a true reflection of what inflation actually looks like?
Yeah.
So a data set of numbers, and let's just say that this is inflation, right? Of various different things over time, right? So time, and we've got a few different variables here. So we might have oil prices, we might have cost of veggies, right? So this sort of sample here is, you would say, a fairly significant trend, right? So if you had hindsight, you'd bet your bottom dollar that things are going to roughly go up in that direction, right? But then we've got these things called statistical outliers. Now these things have the ability in statistics to really warp the journey, right? Because in theory, if you wanted to put a trend line, it might look like this. If you ran a running average, if you included the outlier, it might go like this. And you might say, Jace, well, does that really matter? Well, I'm going to say yes, because if that's the period of 5 years, then all of a sudden that outlier has skewed the results and can potentially have impacts, far longer term impacts than it otherwise should have. Right. So,
which is interesting because you get that in the real estate world as well, right? Because sometimes, like the volume or the volume of property sales, so the number of property sales done, or what might happen is a certain building comes on and it's like some fancy flash building maybe, or something like that. Let me show you something here.
I thought you might have a slide on this.
Yeah. I don't know if this is clear enough to see. We'll see if we can pop it in there. I'll
zoom in on a line at a time if you can.
I'll zoom in. But like, let's say this is some growth statistics. Like I'll show you some growth statistics in this is a suburb in Brisbane, and check out the difference here, Andy. Like negative 26%, folks, and up 80%, right? So statistically, like that's ludicrous. That's a ludicrous gap. That's like 100% change, Andy, in like a 1 year period, right? Or whatever the difference is, between 26 down and 80 up, right? Right.
Take the 5 year average, right? Circle the 5 years. So it's from the negative years, circle the 5 years, or just put a line down the 5 years. Is all of a sudden that,
yeah. So you got to collect them, right? So you go, all right, well, let it wash out, okay? But depending on the 5 years you collect as well, you go, all right, well, is it that 5 years, So what can happen is things can happen like a volume, certainly in real estate, a number of properties could sell for much higher or much lower, and they can skew an average price in a suburb like in an instant, right? So, 100 properties, and normally there's only 20 properties in that suburb transacted a year, and now 100 all happen. This happens often, Andy, in really tightly held suburbs where kind of units and townhouses now come into really expensive house markets. And then you might get 100 units come in at like half or, 2/3 the price of the average house.
Mm.
And then someone sees the average property price in that suburb, not separating houses, and it just goes poof, and it goes 25% down. And people are like, oh no, look, I told you. But it was like, no, it was actually just some units being produced in that suburb, which just haven't been for like years, blah, blah, blah. So, it happens in rezoning, like a really tightly held suburb for houses, and it rezones. And now the average price now gets decimated for years in that suburb because now the density is densifying, right?
Mm.
So the statistics don't make any sense. Like the stats don't make any sense anymore, the average stats, right? So, which, you were showing there before, these are the outlier activities, right? So, how to lie with statistics. I think there's a uni course on that, Alison. Actually,
there's a great book. There's an incredible. It's a very short book because there's only a few tricks in it. But it's it's very, very, very true. And this is the reason why old mate from the Fin Reviews copped a fair bit of a punishing from me over recent, probably more than he deserves, to be fair. But Jesus. How to take a statistic and run with it. So we need to be careful of outliers because they're not a true representation of what the actual position is. And so, Jace, I'm going to bring up this slide here because the Reserve Bank, right, is one of the firmest mandates of the Reserve Bank. Mandate being, Mr. Reserve Bank Chair, your sole responsibility is to manage inflation in Australia and keep it within a band, right? And anytime it's looking like it's going to get out of control, it's your head on the chopping block if it does, and you do whatever is in your control to stop that. But the reality is they've really only got one thing they can control. It's like they've just got a hammer, right? So everything has to be a nail, right? And they're just going to keep belting it in whatever way they can. They've only really got one way of being able to control it. As we alluded to earlier, our Reserve Bank has more measures, but let's just keep it simple for tonight because that's the key one, right? And what they track is headline inflation. And Jace, you talked earlier to what's headline versus core inflation. And headline, like to really simplify the terms, headline inflation is whatever inflation's doing, basically right now. And so that's in here. It's the blue line on the graph. This is from the Reserve Bank itself, publishing lots of data that you picked up, Jace. You picked up and you drew my attention to this. And here's a little bit of I reckon, JW, I reckon that the Reserve Bank is going to be publishing a lot of statistics that are very easy for your average person to understand. The reason being is the government's going like this. Oh, it's the Reserve Bank's fault. And so I reckon one of because I haven't seen stuff like this from the Reserve Bank. It was quite user friendly.
Yes.
For a little while. I reckon they're going to keep publishing this stuff. I reckon they're just going to keep pushing out the information so people have got more and more, and people can make an informed decision. But ultimately, headline inflation. So let's look at it. So right now, headline inflation. Actually, no, this is not quite up to date. But headline inflation starting to run through the roof, right? But the core makeup of headline inflation in this scenario is the total inflation based off automotive fuel, market services, new dwellings, groceries, fuel, which is then made up of a whole lot of other, different things. Now, if we actually start to look at what core inflation is, core inflation removes some of the outliers.
Yes.
right? Now, if we have a look at some of the outliers that exist within our economy right now, we might look at unleaded petrol prices. This spike here we would definitely know as an outlier. Now, it is still high for now, but will it remain high for a prolonged period of time? Well, the market says no. People, here and there say yes, but the market in general consensus is no. It won't remain like this forever. It will what we call mean revert, which will come back to a reasonable average over time. Now, where does that play in headline inflation? Well, it's counted 100%, right? So then we have a look at other areas of the economy. Oh no, that's consumer price index. Let's have a look at a little bit over your neck of the woods. So we'll talk to this for a little bit, Jace. So building materials inflation. What the hell's been going on in your neck of the woods with building material inflation?
Well, unless you've been living under a rock or you haven't been building something, it's been going up. The cost of goods or materials, getting them, has been going up. Again, I think it's not going to be across the whole board here to stay forever. But what we are already seeing are things that are locally needed against the construction volumes. Some early signs of some of these demands actually easing right now. So inflation on the material means, we've just had many tens of thousands of houses be, approved and want to be built by all these first home buyers and free money. But when that comes through, folks, those hundreds of thousands of dwellings actually across the whole of Australia over the next 12 months, there's not another 100,000 dwellings to be built to keep that going, Andy. So I think those demands and those prices will adjust, and it won't be upwards, from that point onwards.
And so in that, sorry, I was messing around with that while you were talking, Jace. Apologies. So within that, but we've had shipping delays, we've had international delays, we have bushfires, we've had that industry. If you go backwards to the trees growing,
timber.
That has just been poleaxed. Floods as well. I mean, that's not good for, regeneration and things of that nature. So this stuff has had some major whacks. And you go, well, those effects are going to be potentially medium term. They're going to be a reasonable part of the inflation, right? Over a longer term, timber, all of these things, probably reasonable to think that there's going to be a price inflation, but just not as aggressive as what it was, right? So this might, ladies and gentlemen, this might be considered to be an outlier, which then pushes through to new dwelling inflation, which is what you said, Jace, which is governments taking their eye off the ball and not doing enough land release to cater for the population. Like, imagine the housing boom we'd be in, Jason, if we still had people coming freely into the country.
If we had 200,000 people a year coming into the country right now, they'd have nowhere to live. Nowhere to live,
mate. You'd want to be like our mates in caravan companies or out good companies, because people would be pitching tents and they'd be looking for places to park their RVs. Totally.
Yeah, 100%.
So when we start to pull these dots together and then we start to look at some of the real stuff and well, this is all real stuff, but some of you may remember when COVID hit, Jason and I started Wealth, Wine and Wisdom around about here. And it wasn't a stock tip because we don't do that here. But there was a very heavy skew to Andy basically saying, I reckon BlueScope is going to go through the roof. Right, is going to go absolutely gangbusters. Australian company, Australian able to resource, it's just going to go berserk. Right, so that did it doubled in half its stock price. I'm not just calling that win, although that was a pretty significant win.
Not
bad, but on the retreat right about now.
Yeah.
Now, multiple different reasons, and I'm not saying it's a bad company to own. I think it's a great company. I think BlueScope is incredible. But this is, potentially, one would say, allegedly, the effects of maybe from here to here is the effects of short-term transitory inflation, if that makes sense.
Yeah.
You couldn't get timber. People were forced to start building metal framed houses because what else could you do it with? People started quoting jobs. All of a sudden, BlueScope Steel became one of the number one people. So when we start to think about headline inflation, which is what the Reserve Bank of Australia is mandated to follow and reduce, and now it's gone out of whack. We're actually incorporating these things like new dwellings in here, where we've got fuel right now. And this, unfortunately, we don't have the most up-to-date data because it's always a quarter behind where we have to look back in order to analyze the data. But I'd venture to say fuel will be up, new dwellings will be up, and they're already significantly rising as points of inflation over periods of time. But then do we go, well, which ones are going to sustain over a longer period of time?
Alison got a bit of the BlueScope.
A bit of the you did. I hope you sold them before they fell off, but you're still well and truly up. And this is why, Jace, it's like you can always talk about stocks. You can see the trends sometimes, but you got to get out. And getting out is sometimes the hardest part because you go, well, I just double and a half my money. It's a great company. You get emotionally attached to it. Anyway, off topic, squirrel. But the beauty about this graph is you can see that if we were to judge back in late 2019, right, the economic future prosperity of Australia and adjust interest rates because of and lower interest rates because automotive fuel and everything else dropped. Look how aggressively it dropped. For 1 quarter. For 1 quarter. Now look how little representation all of this has had until this period of time here. And so the question that we need to be asking ourselves, Jace, in order to make sure that we're not a Whitlam, we don't have that, fear factor where all of a sudden the world is going to end, prices are going to remain high forever. It's just not the case. It's just not the case. It's not a matter of that everybody's wages have got to go up in order to catch oil prices. Not the case. It's not everyone's wages have got to go up to catch energy prices. Not the case, although that is largely government regulated. What does most of, Jace, this is a good one. I'll have to get the statistics later to prove it. But what do most of the higher levels of inflation, so the things that are causing us the most amount of pain, what do all of them have in common?
Personal consumption.
I'll give it to you. Give you hints. Petrol, energy, two of the big ones right now.
Government taxes, excise, or whatever you call them. No?
New dwellings. Yep. Not just the one, but somebody is exerting influence over them.
Yeah. The market.
Heavy
the
amounts.
market's it's not a free market. It's an exerted market. Yeah.
Boom. It's not a free market. It's not a free market. It is a market that is heavily dictated or influenced by government incentives, by government restrictions.
Manipulated. Yep.
That's it. Facebook user. It's government controlled.
Yeah.
So it comes back to a very interesting conversation in that economists always get it wrong. Never trust an economist. The inflation data is built by economists and the forward predictions are built by economists. We're looking at times where the government is pointing towards the Reserve Bank and trying to say, well, you're messing things up when they're operating by the mandate, which, by the way, is the broadest mandate in the world that I know of, in the Western world that I know of. I don't think there's any significant players that have a more broad mandate. All of the big ones have a smaller mandate, which basically just targets inflation. And And we're looking at making long-term decisions, or the market is telling us, or the news is telling us that the world is falling down because this quarter, Jason, 9%. This quarter, it's 9%. And I'm not taking away the fact that it hurts and it can create a large amount of impact on people's lives. I'm not taking away from the fact that when interest rates actually go up, that compounding effect can hurt. What I'm saying is prepare for it, but be careful when investing not to start dumping things that are good value long term, because here's the thing. When it comes to property and even stocks, it's easier to pick the bottom than the top. Far easier. The top is like a tricky thing. When all of a sudden, when things fall dramatically, and then you look for the statistical data to substantiate the fall, you ask yourself, should it have fallen this much? And picking the bottom is extraordinarily difficult. Like, if you could do it every time, you'd be on a yacht constantly circling the globe, unless you're afraid of water. But when all of a sudden the emotion of markets overshoots dramatically, then that is a great buying opportunity. And that's what we want people to avoid, is creating great buying opportunities for other people. Like,
I was going to say for somewhere else. Yeah. Well, mate, at the end of the day, if you can structure your investing in and around, not having to ever be forced into those positions is the best way, right? You can choose if you need to. So, that's something important for people to really sort of make sure that their buffers and war chests and affairs are in order,
and not be scared by whatever the headlines are coming out at the moment. Have a look through it. Have a look, what the composition is, and become more educated in it. And then you'll be able to start to make some better decisions. Because on the opposite side of a sell is what?
Well, as in a CELL or a SEL?
Well, it's the same thing, isn't it? Somebody who picks up. Hello, how's it going?
Yeah, hello.
Thank you very much.
Yes.
There's always the person on the other end of the transaction, and
there's a buyer. Yeah,
there's always going to be a buyer. It's just if you're dropping your pants in order to be able to do it, that buyer is a very, very happy person. And a couple of weeks ago, like we were talking about here, it was the death to markets. There, it was, this is the end, Andy. I think we had a couple of things in there. There goes the end of the share market. It's not the end until there is an end, if there ever will be one, right? Whether it's a Noah's Ark event or something like that. And then, you know what? We're all floating around the big same ocean the same.
Well, that's I say that to clients often, Andy. If it goes to 20%, Andy, well, we're all in the same boat together. So who cares?
We're all screwed.
We're all screwed.
So, who's more screwed? You know who's the most screwed if it does that?
The banks.
The Reserve Bank and the banks, because they're all bankrupts. They'll be asking us for money. They might be taking it from our offset accounts.
Well, mate, it's probably not a bad way to sort of put a pin in the night. At the end of the day, folks, all of this stuff, data, information, details is, Andy and I find it quite interesting dissecting it.
I was just looking at Chucky's next stock tip, please, Andy.
Yeah. Next not stock tip, Andy. All right.
Next not stock tip. That's a great headline, isn't it? What's not a stock tip?
That could be a good. That'd be a good paper. And Alison add a little bit of Qantas as well. So sometimes going against the
well, they were the great ones, weren't they, Jace? And we called them out very early. You called property very, very early in the piece.
Yeah, you called Qantas and a few others where it was like, which companies can the government not afford to let go broke, and they're going to take care of them? And you called it, man. So airports, Qantas, Australian companies, where's the money going to go? So, smart moves. Well, there you go, folks. Few different.
Let's for all the property investors out there, If you'd owned one stock over the last 12 months that'd just make you happy as Larry, what would that stock be? I'm just interested. Do you know? You might know because you maybe you're all in property, maybe. But think about income. Income's a good thing, and hopefully, it was a painful year. Hopefully, we're going to get somebody on to talk about this because there's something very interesting that that Jace picked up. What's this one? FOMO, my God. Oh. Clearly, I don't understand the acronym there, one. But mate, this is one that you brought to my attention. I think this is where we can put a bit of a pin in it for tonight.
Yes,
and a bit of a teaser for next week. Is BHP's dividend. What the hell? What's going on with BHP? Have they just nutted it? What's the deal? And mate, we're probably going to see a little bit of this action, not a lot, but a little bit of this action over the coming months and year. But the question I'll let hanging for this wine and wisdom is, what leads to a 13% dividend, and would you want to have it? And does that mean you end up going out and buying a whole lot of BHP? It's a good question to ask. I'm not going to allude that any of them are the right things to do, but mate, 13% dividend, wouldn't mind being involved in a company that punches that one out. And maybe next week we'll go into we'll try and invite one of our learned friends to come in, far smarter than me, to come in and maybe dissect some of the big wins in the market.
David reckons we've been talking a big game for years now, Andy. So the only guest he ever remembers is your dad. So we better follow through on a guess, Andy. It's over to you.
Well, to be fair, Dave, we have had Paul on, we have had Malcolm on, we have had we have Kelvin. We probably had 5, I reckon. But we've probably said
less than
a few
5% of our episodes have had guests. But I think we've every single episode we've talked about getting a guest. So let's make it 6 guests, Andy.
100%. Jeebus creepers, tough crowd tonight. Dave's on to us. Like, come on, not putting up with any more of your bullshit. These are fake headlines, Witten.
Fake news, Fenton. All right. Well, I think it's a good way to finish the show. Allison's up 116%. I think that deserves a round of applause. And Chucky reckons he'll be a guest. So, there you go. All right, folks. Well, listen. Why don't we call it quits, Fenton? I think we're done. We're done.
Right. It's a very dry topic, isn't it? Inflation, interest rates, you get into bonds and all of that stuff. It's not really all that interesting. It's very complex how it all interacts. It's not very interesting. It's how the world kind of evolves and it's how the world is sort of run. But hopefully we can make it interesting for you. And I guess my intention for tonight is really just, there's going to be a run. The Reserve Bank will likely raise interest rates aggressively at some point in time. But understand that they raise them aggressively, they drop them aggressively. And these things can be as short-term as a haircut sometimes, depending on how you cut your hair.
Speaking of, I think I need a haircut, Fenton. Anyway, there you go.
It's on for next week. I think I need to dye too, mate. I need to come back more to your colour. Look at this.
Bit of grey away, mate. Bit of grey away. It'll help. There you go. Mate, well, buddy, I think I've had my wine. I'm done. Good to hang out with you. Thanks, Bryce. Thanks, Bob. Oh, yeah, you've got the glass. Appreciate you guys hanging out with us. Well, let's call it done and dusted, folks. You guys have an awesome weekend. Thanks
and
for
a heavy
hanging out.
Commitment that I promise I will ask. I will do everything in my power to get somebody a little bit more interesting than us on to next week to have a chat about what's there. But here's the thing. All right, I'll do it on Monday. So if you guys see it, we will advertise it early in the week on the various different channels. We'll put out a little bit of a post. We'll let you know that one of our colleagues are coming along, having a little bit of a wine with us. So if you see that, come on and join us because there's a good chance that we'll make somebody very, very learned, and we'll expose you to them. Probably very uncomfortable at various different points in time.
All good. All right, mate. Well, thanks, brother. Good to see you. Good to hang out with you as always, and have a cheeky wine and talk about the week. And thanks to you folks. Appreciate you. Have an awesome weekend. And I think that's a good night from him.
And it's a good night from me. Good night, everyone.
Good night.